Welcome, dear traders. You're watching a recap of the Asian session. Optimism returned to stock markets thanks to coordinated actions of central banks aimed at helping the struggling banks. Yesterday, US stock indexes climbed markedly, and today Japanese stocks soared. Even Australian and the New Zealand shares rose higher. The main event of the week, the Fed meeting, will take place today. The turmoil in the banking sector made investors revise their forecast for monetary policy, and they no longer expect a 50 basis point rate hike. The central bank could either raise the interest rate by 25 basis points or take a pause in monetary tightening. It could also leave the key rate unchanged in the current range of 4.50 and 4.75. If you have watched our video reviews at the end of the last week and the start of the new one, you are well aware of how rapidly market expectations are changing. For example, on Monday, the ratio was almost 50-50, and yesterday the majority of traders priced in a rate hike. The ratio amounted to 80%. According to the FEDWATCH tool, the ratio has changed even more today, reaching 80%. While the vast majority of investors are factoring in another rate increase, the weeks saw the sharpest two-day decline since May 2022. For comparison, over the past 12 months, it has declined by 1.6%. Over the past day, it has dived by almost 3%, reading at 21.38 on Tuesday. Such sharp fluctuations were triggered by turbulence in the banking sector, and the main lenders adopted a rescue plan to help First Republic Bank. Its shares at some point soared by a whopping 55%. Apart from that, Finance Minister Janet Yellen said that the government is ready to take further action to guarantee bank deposits are safe. A dynamic and diverse banking system was needed to support the U.S. economy, with the large, mid-sized and the small banks all playing a role in supporting households and the small businesses, she said. Yellen added that the government is willing to provide liquidity to commercial banks if needed. Given a tight labor market and higher than expected inflation figures for February, the Fed will have to make a very difficult decision. That's why the US dollar moved to a consolidation phase earlier this week. It has been trading in a narrow range of 103.10 and 103.30 for some time. It still resists bearish pressure, and however, on Wednesday morning, it dipped lower. The US dollar index is moving near a 5-week low of 103.20 versus its main rivals. Moreover, technical indicators signal a further downward movement. The greenback may enter the horizontal support area of early January between the levels of 102.65 and 102.55. However, it may also advance to the resistance level of 104.25. The yen regained ground following the weakness of the US dollar. However, there was also another strong driver that helped the yen climb. Chief Cabinet Secretary Hirokazu Matsuno stressed that the government would allocate more than 2 trillion yen from reserves to protect households from rising prices. The joint efforts of the government and the Bank of Japan could boost the yen in the long run. It has been weak in recent months, boosting import prices. In turn, it undermined the standard of living. Hirokazu Matsuno's statement bolstered bullish sentiment in the stock market. Financial companies scored the biggest gains. For example, Mitsubishi and Mitsuho Financial shares grew by 3%. Sumitomo Mitsui stock advanced by 2.8%, and the shares of Akeans, the leading supplier of sensors and measuring devices, increased by 3.2%. Against the backdrop of easing concerns over the banking crisis and the positive statements from the Japanese government, the yen rose as a safe haven asset. Its price advanced to 132.50. Even improved risk appetite did not spook the bulls, so the yen kept moving in the channel of 132.20 and 132.80. In the afternoon, the trajectory of the dollar-yen pair will depend entirely on the Fed's rate decision and Jerome Powell's speech. If Powell makes hawkish statements, the US dollar may recover. If so, the pair may approach the resistance levels of 133.60 and 134. The Reserve Bank of Australia is now less hawkish than the Fed, so the Fed meeting and the Powell's testimony will inevitably lead to sharp price changes in the AUD-USD pair. On Wednesday morning, the Aussie was trading in the upward range of 0.6661 and 0.6705. However, its growth to 0.6691 looks unstable as the US session and the Fed meeting are approaching the volatility of the Aussie could increase. In the event of a dovish move by the Fed, the AUD-USD could climb to the resistance level of 0.6712 and Tuesday's high of 0.6726. However, return to the support levels of 0.6635 or even 0.66 is more likely. The prospects of the New Zealand dollar look more dismal given the country's weakened economy. However, today the Kiwi was able to rise to 0.6217. Bulls and bears are tussling before the Fed meeting, so the pair consolidated in the range of 0.6172 and 0.6223. Today, traders are focused on the Fed meeting. Will the regulator maintain its hawkish stance to cap inflation or take a pause? Further movement in markets depends on the Fed's rate decision. And we will talk about this in more detail tomorrow in our next video review of the Asian session. So that's all for now. Don't miss our next video review and see you soon.